Cryptocurrencies have been a hot topic in the financial world for over a decade. With stories of early adopters turning small investments into millions, many wonder if they've missed the boat. Is it too late to invest in cryptocurrencies? The short answer: no, but it depends on how you approach it. Let's explore why crypto still holds potential and how to navigate this evolving market. Why it's not too late. Cryptocurrency is still a relatively young market. While early adopters reaped massive rewards, the crypto ecosystem continues to expand with new projects, technologies, and applications. Here's why there's still room for growth. Mainstream adoption is growing. Major companies like Tesla, PayPal, and Visa are integrating cryptocurrencies into their business models. Governments are exploring digital currencies, and blockchain technology is being adopted across industries. This growing acceptance indicates a long-term future for crypto. Innovation is constant. Bitcoin and Ethereum may dominate the market, but thousands of altcoins offer unique solutions to real-world problems. For example, decentralized finance, DeFi, platforms, non-fungible tokens, NFTs, and blockchain-based gaming are reshaping industries. Investing in innovative projects could yield substantial returns. Market cycles create opportunities. Crypto markets are highly volatile, with regular cycles of booms and corrections. While volatility carries risk, it also creates entry points for new investors during market dips. Timing your investments carefully can lead to significant gains. Do your research. Educate yourself about cryptocurrencies before investing. Understand the technology, use cases, and market trends. Reliable platforms like Binance Academy, CoinMarketCap, and YouTube channels focused on crypto can help you make informed decisions. Start small. Invest only what you can afford to lose. The crypto market is unpredictable, and prices can swing dramatically. Starting with a small amount allows you to learn the ropes without risking your financial stability. Diversify your portfolio. Don't put all your money into one coin. Diversify across established options like Bitcoin and Ethereum, as well as promising altcoins. Diversification reduces risk and increases the likelihood of tapping into a successful project. Use dollar cost averaging, DCA. Instead of trying to time the market, consider dollar cost averaging. Invest a fixed amount at regular intervals to smooth out the impact of market volatility. This strategy ensures you buy both highs and lows, balancing your overall cost. Secure your investments. Crypto security is crucial. Use reputable exchanges and transfer your assets to a secure wallet, preferably a hardware wallet. Enable two-factor authentication and stay vigilant against scams. Risks to consider. Market volatility. Cryptocurrencies are notorious for price swings. Be prepared for potential losses and long-term holding periods. Regulatory uncertainty. Governments worldwide are grappling with how to regulate crypto. Changes in laws could impact prices or even restrict access to certain assets. Scams and fraud. The crypto space attracts scammers. Stick to well-known platforms, verify sources, and avoid get-rich-quick schemes. It's not too late to invest in cryptocurrencies, but success requires a cautious and informed approach. The market offers opportunities for those willing to learn and adapt, but it's essential to manage risks and set realistic expectations. Treat crypto as part of a diversified investment strategy, and you could still benefit from its long-term potential. Cryptocurrency isn't a guaranteed path to wealth, but with patience and prudence, it can be a valuable addition to your financial portfolio. The key is starting smart and staying informed.